Hi, I'm Robin Pye. I'm here with Melissa Kane. We're with Mueller Pye and Associates, and we want to talk to you today a little bit about depreciation. So Melissa's going to start us off.
Before we start there, we are here at Nueces Brewing and Barbecuing in beautiful Corpus Christi. The co-owners, Kale and Brandon, have been nice enough to share some beer and food with us and let us report on their beautiful property. But to just dive right in, some of the basics of depreciation: if you buy any fixed asset that's over the threshold of $2,500, you are not allowed to expense on your P&L. You must capitalize it and then depreciate it over the years of its class lives. By class lives, I mean each kind of property has a different life that is depreciated over. The most common ones are 5, 7, and 15 years, which is usually your furniture, fixtures, and equipment. They go up to 27.5 for residential rental property, and then all the way up to 39 for buildings and other business real property. Currently, there are a couple ways that you can accelerate the depreciation. Right now, we have bonus depreciation, which is at 100%. That just means that in the year that you buy your asset, if it was purchased between September of 2017 through December of 2022, you can depreciate the full cost of that asset in the year that it's purchased. However, going forward, those rates drop about 20% each year. So for 2023, anything purchased after January is going to be at 80%. For 2024, starting in January, that'll be 60%, and then further reduced to 40% once you hit 2025. Another way to accelerate depreciation is Section 179. The current rate for that is around $1.1 million that you can depreciate. That now includes qualified improvement property, HVAC, as well as roofs.
Yeah, so that's different. So there is a difference, though, in the 179 and the bonus. So I want to talk just a little bit about that. So if you elect the Section 179, there's some limitations on that as far as taxable income. So you cannot take so much Section 179 depreciation that you have dropped your business profit below zero. So in that case, that Section 179 depreciation carries over to the next year and offsets your income for the following tax year. With the bonus depreciation, there is no taxable income limitation, so it can drop your taxable income below zero, in which case you're carrying that over in the form of a net operating loss. It's a little nuanced, but it's a big difference from a tax perspective, because if you're carrying over the Section 179 to offset the future business income, that is a reduction of taxable income and also of self-employment income. If you're subject to self-employment tax. If you have elected the bonus depreciation and carried that loss or that excess depreciation over in the form of a net operating loss, that is not a reduction of your self-employment income for that following year. So it can make a huge difference in terms of whether or not you choose the Section 179 or the bonus. So it's just a conversation that you need to be having. Hopefully your tax professional is raising that issue, having that conversation with you and explaining what they think is the best election for you, but it makes a big difference. So just make sure you're educated so that you know to have that conversation with your tax professional if they're not bringing it up.
Okay, so one last thing on depreciation. So let's say that you've constructed or purchased a building, and as Melissa mentioned earlier, that property is subject to 39-year depreciation. So one of the ways, or the only way to get around that, is to have a cost segregation study performed. The idea behind a cost segregation study is to take the cost of that, say, $4 million property and break that cost out into the various components and the different class lives that you can assign to those components, such as 5-year, 7-year, 15-year, so that you can take advantage of that Section 179 or bonus depreciation to accelerate that depreciation and not have to take that whole $4 million over 39 years. Typically, you can recover about 30% of your total cost in year one with a cost segregation study. So the cost of the property does need to be somewhat high in order to make it worth it, but definitely something that you want to be asking about, talking to your tax professional about. So I think that's all we had here. So thanks for joining us, and please check out Have an IPA with a CPA. Thanks so much.